Okay, how's everybody doing? We've got a special Wednesday stream because the federal. Oh, look at that! We are pumping. Ooh, let's see what we got. Come on, give me some news here. Let me move this over to the other screen so we can see it over here. Waiting for 75 basis points. There we go. That was what we were expecting. The market was looking for 75 basis points. There was a lot of talk about 100. A lot of talk about 100. More so than in the previous meetings. I was thinking that the 100 basis point rate is it's even though it's technically likely, I thought it was kind of unlikely, actually. That was my thought because there's always a little bit more bearish or bullish rhetoric going on in the media. Whatever the trend is, they're going to be a little bit more so than that trend. And right now, we've got the 75 basis points, which was what they expected, which is why it's pumping. There were a ton of bears because there was so much talk about the 100. It was all about the 100, 100, 100. Everything you heard was 100 basis. So they'd be like, yeah, it's probably going to be 75. But 100, blah, blah, blah. So there were a bunch of people short because they thought, oh, here we go. The Fed's going to screw it up. You know what? Look at the inflation numbers yourself, right? It's in line with what had happened before. And technically, it is a little bit lower. It was like 9 point something, then it was 8.5, then it was 8.3, right? So I mean, I call that flat, but it is sort of going down a little bit in that sense, but that doesn't mean anything because next month we could get an inflation number of 12% or something. You never really know. But it's going to take a while for all this stuff to cut through the markets, and I think the noise was getting people way too bearish, which is why this is a huge squeeze on this opening candle right here. Usually you do see a lot of movement like this, but most of the time it's kind of both ways. Usually it'll kind of go up and down. Right in this first candle. This is a 3-minute chart that we have right here. In fact, let me zoom in on this so we can get a little bit better picture. What did I just do? Oh, that was the news. We don't need the news anymore. I'm actually going to go ahead and close this for now because we know it's 75, but we're watching this candle right here. A little bit later, I'm going to bring up Jerome Powell's interview about 11:30 Pacific. We'll see what happens. That's when trades are going to go down if I'm going to make a trade. Now, I've been talking about this for a while. The last 3 Fed meetings, I've made a trade to the upside. That's kind of what I'm thinking yet again because we have to see if things are in line, but if they're in line, that's what I'm thinking. We've got a lot of bears. I mean, I was looking at short interest on a lot of different things, and it's going up because people thought we're going to crash here. I mean, they don't learn from previous events. It's just over and over and over again. We get the same thing. We get people coming in, shorting the crap out of the market, and then getting squeezed out when something doesn't go down, right? It's like it never actually goes down. I say this all the time. I mean, yeah, there are declines. Things happen. Oh, wait, actually, hold on one second. I got to adjust some things. I knew this was going to happen. There's always, I got to turn the sound off for there we go. That way I'm not getting, I was trying to open up Twitch because I forgot I don't have my chat open, so I don't know if anybody's even watching this right now. So let me go to my dashboard here and see what we got. Looks like we have nothing going on right now. Very cool, very cool. I don't expect a lot of people to be in this considering it's a weekday. It's early on. Some people are either busy or they're trading themselves, so it's probably not going to be much. But this is more for recording on YouTube purposes and to show that something actually happened. So right now we've got a pretty good pump. We haven't gotten a decline yet. Usually there's a pump and a decline and it kind of travels through the middle. So we'll have to see what actually happens this time considering it's a little different. I mean, inflation is still high. As much as I say it's in line with what we had before, it's still high. So something has to be done. But is it 100 basis points? Is it 100 basis points? Is it 125 basis points? Do we have to crash the market extremely? No, we don't have to do stuff like that. We can just go with what they were saying before, and that's what the important part. We're gonna see what Jerome Powell says. He's going to come out at 11:30. He's going to talk about the Fed's plan. So we've got the interest rates, which is one part of the equation. The rest of the stuff we have to look at is what's going on with QT. Right? Are they keeping the same plan? A little while ago, they weren't dropping their mortgage-backed securities. I actually haven't checked in a while, so I don't know if that's still the case. But hopefully, if that's the case, Jerome Powell will address why that's going on. I mean, saying you're going to dump $17.5 billion worth of mortgage-backed securities over 3 or 4 months, and then adding during that time instead. You know what? They probably were selling, but they were also adding. So that they need to talk about that because I haven't seen a whole lot of talk about that in the media, and maybe that's not a thing anymore. I've had so much stuff to do, I didn't really have a chance to check. But what we're looking for here, I made a little list. 75. I wrote 75 basis points, most likely 150 or 150. Are the other two candidates. It could have been a 50-pointer. See, that was what I was thinking. I thought it was between 75 and 50 because things are in line. But if they go too low, they know the market's going to panic about that. And if they go too high, then obviously they're going to cause more problems because this is cumulative. The more they do this, the harder it hurt, or the harder they let me rephrase that. The harder they jack rates up, the more pain companies are, or I should say, the more pain institutions are going to feel, because they're getting squeezed with the money that they were using to do everything. Like, they were getting all this free money, well, close to free money, but they were getting tons of cash. They were pumping it into the system. They were able to make all kinds of trades. If there was a problem, they could go to the repo market, overnight rates, whatever. But now things are tightening up a little bit, so it's not going to be quite as easy to do what they were doing before. So yeah, we got the 75 basis points I wrote on there. So the dot plot update. That's what I want to see, is the Fed's new dot plot. And the dot plot is what the Feds vote on for interest rates now and then estimated in the future. So basically for the next 2 years, their estimates on what their votes are going to be for interest rates. So each Fed president is kind of listed as a dot, so you can see how many people voted for what level of increase. And that was telling us that we were going to peak in early 2023 and then start to come down a little bit. So if that's the same, then we're right on track. But if they update that a little bit and they say, hey, maybe it's going to stay longer for higher, which I actually think is likely, because a few Fed presidents have said that they want to keep rates going higher for longer, or just they want to sustain rates, because there was a talk about, quote, peak interest rates. They're thinking, oh, interest rates have peaked, or they're about to peak. That's speculation, according to one Fed president. So it's probably going to last a little bit longer. They're probably going to be higher, or they're probably just going to be sustained for a little bit, because that's the thing. We have to squeeze the inflation out of the system. Like, the whole point of quantitative easing and lowering interest rates is to add money to the system. It's to encourage loaning, which increases the money supply. It's to encourage people to get out there and actually spend and put money into things that will prop up the economy. And that works, basically. People argue about it. It's like, oh, it's eventually going to it's going to destroy things. Yeah, it probably will. I mean, you can't just do this forever. But for now, while things are still working, while people still believe in the dollar, no matter what you hear on, whatever bear podcast, that the dollar is going to crash and there's no faith in it, people have extreme faith in the dollar. Everybody's moving into the dollar because it's safe right now. The system is nowhere near collapsing. They're like, oh, it's Rome. It's Rome. We're at the end times. Like, yeah, I mean, I can see similarities to stuff like that. And I do think there are problems. And if we continue to go on certain trajectories, we could be in trouble. But we're not there yet. I mean, things don't happen in the blink of an eye. You have to think of things over deep time, or at least some longer time period, because things don't just instantly stop or instantly start. That's kind of the thing. Everybody's like screaming about all this political stuff. No matter what you want, it's going to take time to implement it. Like, if you want this perfect utopia, there are things that have to happen first before the things that you want. So it's going to take time for all that to go. Like, our species does things over a long period of time. That's how we're judged. If you look back on history, you don't just pick one day. You pick a huge time period and you kind of lump it all together, because that's all you can really do. There's so much information out there. You can't look at every second of every day throughout the entire human timeline. I mean, we don't even have records of all that. But we do have records of here and there. Somebody kept records of grain a long time ago, and now we've got a tablet that says, hey, look, we used to keep records of grain like this. At this period of time, they were doing this. And it's kind of what they would do here. So anyway, that's a tangent. We got to get back to what's going on with the Fed. So yeah, my list real quick before I check chat again. 75 most likely, which is what happened. What's up with the dot plot? We want to know that. What's the status of quantitative tightening? i.e. what's up with the mortgage-backed securities, if that's still a problem. What are the Fed's thoughts on overcorrection possibility? So someone's going to ask that. When they do the Q&A, there are going to be like 3 people that go, do you think that the Fed's going to overcorrect and crash the economy? That's going to happen over and over. And of course, Powell's going to sit there and talk and be like, oh, blah, blah, blah. There's maybe data dependent, blah, blah, blah. They're going to say data dependent 50 times, right? If you played a drinking game, you'd be hammered by halfway through his speech. But that's good, because that's what we want. We want somebody that's data dependent. We want to make sure they're not overreacting like the media does. I mean, the media is there to get everyone else riled up. The Fed has to go and separate that and say, okay, what's actually going on? What actions can we take that will actually help things? And that's what they're trying to do. I mean, I don't know what everybody's mindset is, or if there's like some secret cabal controlling the world or whatever, but like what I do know is, like, we need stability in the markets, and that's what they're trying to do. Regardless of what else is going on, they're just trying to stabilize prices so that things aren't crazy. Because like, inflation hurts everybody. I mean, it hurts from the poor all the way to the rich. It does hurt people. I mean, if you have more money, you can sidestep it a little bit, but there are people that are living right on a line where everything's okay, and if it just moves up a little bit, then things aren't okay anymore. So they're trying to move that line back down to make more people okay, which is what we need, which is what we should do. Especially if you have money, you should be rooting for that. You want everybody to do well. So the last thing I have on there, the labor market. Okay, so are we still in for a soft landing? Because they keep talking about soft landing this, soft landing that. That's basically saying, are we going to destroy the nice unemployment number we have right now? We want to sustain that. We want unemployment to be low. I mean, everybody does because it helps the economy. The problem with that, though, is it increases inflation. So the more people we have working, the more money we have in the system. The more money we have in the system, the more we can push up prices. And that's not the only thing. Wages aren't the only thing, but it's one piece of the equation. So what would be nice is if they could drop the price of everything else without having to crush the labor market too bad. However, it's kind of inevitable. I mean, we've already seen a slight drop in the unemployment. It's gone down by like 0.02% or 0.2 or whatever it was. It's gone down a little bit, or I should say it's gone up. Unemployment has gone up a little bit. Not a lot. It's still in a really good range, still towards historic lows, but it has moved a little bit. And the more the Fed does this, the higher that number is going to go. That's just inevitable because that means companies don't have the money to hire more people. I mean, all I'm hearing about right now is this company cut 20% of its workforce. This company cut 4% of its workforce. I mean, that's what people are doing right now. They try to cut costs in the stuff that they're ordering and all the goods and stuff that they're selling. You know, whatever they can do to cut costs there without having to get rid of people, they do that first. And then they start moving to getting rid of people. And after they start getting rid of people, then you start getting into the what are we going to do now? You know, do we take out loans? Do we sell bonds? Whatever. So we'll see stuff like that probably later on too. I mean, the corporate bond market is going to be interesting at some point in time. So those are the points we're looking for right now. We've got the rates. We are waiting till about 11:30. It's 11:11 at this point on my time. So we've still got a little bit less than 20 minutes to go until Jerome Powell starts talking. And that's the important part. I mean, what is Jerome Powell going to say? So we've got the rates. Obviously, the market likes these rates. I mean, we've gone up on, let's see, this is the SPXU, which is, this is inverse. Hold on a second. So let me switch this over to the SPY. Actually, I forgot I'm not on the SPY. So the SPY is not happy right now. They don't like the rates. Okay, I'm all confused right here. So that was actually, so that's not so good on my part because my trade is to the downside on SPXU. I was expecting the markets to like a 75% or 75 basis point hike, but they don't that much right now. I mean, this isn't all that much. What do we drop? We went from 387 down to 381, so we dropped about 6 points. That's not terrible. We're still trying to figure things out, and usually there's a little bit of a decline. And during the day, we've actually had, if you look at this, so we've got the last few days. So this over here would have been Friday, or no, is this Tuesday? Okay, let me change this to a longer term chart real quick. Let's go to the 5-day 5-minute right there. Does that get us back a little bit farther? Okay, Sunday, Monday. So we've got Monday going on over here. Where are we here? Monday starts right there. Okay, so we had kind of an uptrend on Monday and a little bit of a downtrend on Tuesday. So we ended up kind of flat. And now during the day, we were basically flat from where we closed yesterday. And then there was a slight buildup until we actually got to things. So where are we right here? And this was pre-market. So yeah, there was a slight buildup in the pre-market. And then once we got to the open market, it just went flat. And if you look at that line, it's right across where everything was trading. I mean, you see this big woo, woo, woo right here. It's all centered around this point. It's going above it, getting pulled below it, getting pulled back above it, getting pulled below it. And you can see when it starts to stable out right here, this is where people were thinking, all right, this is an okay spot for me. A lot of people were getting out. A lot of people were getting in. And there's a lot of people like me that were expecting a jump. So that's why I think this was climbing up, because every Fed meeting has had a pop afterwards. And I think traders are trying to position themselves in a way to get that. However, what we need for that pop is we need people to be bearish. And people are extremely bearish. But people are also learning from the last few Fed meetings and saying every single time the same thing happens. So should I do what I did last time and get crushed? Should I short the market and get crushed again? No, I should go long. And now people are down. So this is what I want. I want things to go down before he speaks, because usually when he starts speaking, there's a crash for, I don't know, 3 to 5 minutes, maybe a little longer, and then it kind of pumps. But what the market is waiting for is for him to say, 1, data dependent, 2, everything's in line, 3, here's our dot plot still the same, everything's good. They want him to come out and reassure everybody that everything is going well and it's going to according to plan, which so far it looks like it probably is. I mean, I don't necessarily think this is going to be as easy as some people do, and I also don't think it's going to be as difficult as other people do, but I do think the fact that they're doing something and they're not trying to overdo it, they're trying to do just enough to appease the market and just enough to start bringing things down, but not enough to really hurt things. And they're doing it quickly. Like I was going to say they're trying to do it slow, but they're not. They're not doing it slowly. They're doing it very quickly, because 75 basis points 3 times in a row is massive. We haven't seen those kind of hikes in a long time. And I mean, usually we're hiking by a quarter of a point, or hiking maybe even less than that. Sometimes there's like 10 basis points. It's just, this is insane. We're in a time where they're really moving, but they're not panicking the way some people are, because I've heard 100 basis point rate increases for the past 2-3 meetings. In fact, the last meeting, somebody was predicting 125 and they were sure of it. They were like, pin my comment, it's 125. I'm like, well, it wasn't. It was 75. So it's the same thing keeps happening over and over again. The Fed isn't going to overdo it. They're not trying to crash things, and they're not trying to panic anybody. So that's the other thing. I don't think they would overdo it simply because they don't want to panic people. Even if there was a reason to, they would go as hard as they can, but they don't want to panic people, because if they scare people too much, then they're going to cause problems. Like if they're worried about the labor market and they scare the crap out of the economy, well, the labor market's going to get hammered even worse. So that's where we're at right now. We're kind of just watching this thing. We're seeing, all right, can they do this without hurting the labor market? Can they continue their plan? Is what they said before still in line with what's going on now? That's the big one, because if it is, then we're happy and traders can bounce. And that's what I'm waiting for. If they come out and they don't say that, I'm not going to make a trade. Right now, all of my trades are probably underwater. I can't look at them because I've got this screen up right now, and I don't want to anyway, because this is not going to be good. I mean, everything I bought, I did buy some downward protection too, because I thought, all right, there is a chance that this could happen, so I'm going to buy some cheap downward protection, but I don't necessarily think those are actually going to be in the money yet. In fact, let me pull up my stuff and see what I've got going here on my other screen. So yeah, the one that I have, so I got a call. Let's see, I've got a 20 call, which it's definitely not for that SPXU, and it's up about $10. Ooh, big deal. But my other trades are down. Of course, I didn't pay much for those, which is good. I did, however, pay a little bit more for some on my other account, which I can't get to right now because it's not letting me bring up my thing here. Let's see how we're looking. Oh man, those calls got crushed. They're not doing so well right now. Hold on, am I going left and right channel here? There we go. I think the cable was getting pulled here. So luckily I bought some with a little bit of time. Oh, those are the calls. So what are those at right now? How much did I pay for those? Okay, those are up about $15. So I've got a few calls. I'm not making a whole lot on those. On this account, I've got one call on the other account, and then nothing on the other account, which I should have bought some. I should have bought a strangle on that one too, because there were some cheap strangles on some of these levered products. I was buying cheap strangles. I was buying like $5, $4, $3 options. I mean, because things can move so much that in my mind it's actually worth it. Like, and I wasn't throwing that much down. I mean, I threw probably like between 50 to $100 at these little options. Actually, less than that. I would say it's probably like not 100. So yeah, let's say like $50, $60 at these random options that expire this week. So if I lose that $60, I really don't care. I have some longer term trades. I bought into more of the stuff that I like, so that's going to get me to the upside. I do have some downside protection, so if we have an extreme downside move, I'm going to cover some of my losses. I'm definitely not going to do as well as if the thing pumps, which is what I'm hoping for. But right now, this right now is actually making me a little bit nervous, because it's different than what we've seen before. However, if it holds this spot right here, that's good. So what you want to see is that first candle, that first like 5 minutes or so, when the rates come out, everybody's adjusting to it. Things are dropping, things are pumping, and then it kind of settles a little bit. If it stays in that range and then Powell says everything's in line, that's where I'm going to jump into some trades. So that's the important part. You want to listen to, like, is it in line? Is he saying everything's good? Is he saying inflation still looks good? Is the dot plot still relatively similar to what it was before? So that's what I'm looking for when this comes in. This is going to be intense for a few minutes. Like we're waiting for just 5-10 minutes of time to make a whole bunch of decisions. That's my whole deal right now. I just want to see, is it in line? Because we got the rate that I expected. The market is not super happy about it, but because it's not dropping more, it's not that unhappy. I think people were expecting something different. I think people were way too hyped up about that 100, so they dropped it. Because the people that think it's going to be 100 think inflation is so bad that we have to crank it down to the point where it's going to hurt things. And I don't think that's necessarily the best way to go, because if we crush everything, you make a bunch of people lose their jobs and lose their houses and stuff like that. I mean, that's even worse than having some sustained prices for a little bit longer. So I agree with the Fed in the sense that we need to do this. We need to have a soft landing. We need to take these things down. It's going to take a little bit of time, but once we get out of it without destroying things, we'll be a lot better off than if we create another 2008. If we crash a bunch of companies or something like that. So right now we are still kind of in that range. It's pumping a little bit, but you notice right now the top is kind of sitting right here at this 381 mark. The next place that it could go to is the 382 mark, but we'll see if it has to break this little section first. And this is technical analysis, so this may not matter at all. Let me zoom in a little bit. We can get a better reading on what's going on here. There we go. In fact, let me pull the volume down a little bit. So look at volume has been dropping off, actually. Oh man, sorry about that. The cable's being weird. I'm trying to hold it so it doesn't do that, but the cable, I think, needs to be worked on a little bit. Get this out of my way here. So what we're looking at here is the volume. Did I move this over? I think I did. There we go. Yeah, we're looking at the volume. It's dropping down a little bit, which is to be expected. You can see this first candle had the most action. It had way more volume than anything else. In fact, let me bring this up. This is normal right here. Usually the algos are going to trade and be out quickly. Traders that are watching it, they're going to be in and out quickly. So volume is going to be really high for that first adjustment. But because it's coming down, I think the market is settling at this point. And so far, if I bring this chart down a little bit so we can actually get a better look at it, let me squeeze this one down a little bit more too. There we go. Get a better look at what's going on. You can see that it's settling, and now that the volume is dropped, things aren't moving quite as quickly. So traders are just waiting for Powell now, right? There are people that are scalping. They're basically trying to get little, few cent moves and stuff like that. It's kind of dangerous, actually, because you can do really well at that and get addicted to it, and then it can just really crush you. So there are a bunch of people scalping right now. People are getting ready for the speech, but most of the big movement has happened. So the question is, how long is this going to last? And how are we doing on time here? Let's take a look. We are at 22, so we have 8 minutes left. I'm going to leave that clock up, actually. So we've got about 8 minutes left until Jerome Powell comes out. I need to actually go ahead and get Powell going here. So let me go to YouTube. Let's look for, there is FOMC press conference. That's what I'm looking for. We're going to leave that muted. I'm going to go ahead and move this over here so we can actually get it in screen. No, I don't want it full screen. We're going to do what we did last time. We're going to set it up over here in the corner and get this, hopefully see as much of the chart and the trading action as possible. I would like to see that. So you know what? Actually, I'm going to bring it down here a little bit. So what we're going to do is we're going to go like this. Get the corner here. Bring this under. We'll just keep the main trading block going right there. So do we want this one? No, we'll just do the regular one right here. In fact, I'll back up out of that a little bit so we can get a better look. Let me zoom out a couple of spots. There we go. Now we can get a better look. How are we doing? That's like a 5-cent jump. That's perfect. So that way we can see things moving a little bit. I like having this level too. I mean, it's active trader on Thinkorswim, but I like the way it's set up because it shows you price vertically, so you can kind of see, is it going up, is it going down? You can see the orders moving right here. You can see the volume over here. So we've got volume and trade count. I like to have both of those things up because that can tell you, if there's high volume with a low trade count, that tells you there were big players making moves. If there's high volume with a high trade count, then you can tell it's everybody. It's a good way to see who's trading, because if there are large block trades going on, that's going to tell you that it's an institution. And a lot of times institutions have a little bit more information than we do. Not always. I mean, if you look at their returns, they're usually not as good as the S&P, but in any given circumstance, they can have some information. So it's something I just like to take into account. Hey, Sloan Fishby, how's it going? Great stream, homie. I don't know if I'll make it to the end of the meeting. Got to pick up the girlfriend in a bit. Hey, I feel it. If you're gonna stay, hang out till about like 11:30, 11:40. That's when the important stuff happens. We're waiting for Jerome Powell. He's getting close to being out here right now. But we're not quite there yet. So let me open this back up. So we've got YouTube going just so we can see all this. I would like to have, okay, there we go. Maybe I'm going to have to move this a little bit more, move it in a bit. I don't know. So we can get the news. Oh, there we go. Let's see if we can get the news. Actually, we can get that stuff. All right. Maybe not. In fact, let me scoot this. Oh, whatever. I'm just going to leave this like this. So we're getting ready for this. We're getting ready for this right here. It's coming. What do we got? So we've got another 6 minutes. We're still holding that level. I need to get my trades ready, actually. So I'm going to be looking into a couple of trades. I'm going to stay logged on that. So when Jerome Powell starts talking, I'm going to be quiet. I might chime in a little bit here and there. I'm going to let you know what some of my trades are. I don't know if I'll have room to put some of the stuff on the screen. Also, here's the thing. I'm a little bit superstitious, right? Like I consider myself like not really like a smart guy, but I'm smart enough. I'm capable enough. I have some kind of common sense, at least. I would say at least an average bit of all of that. But I am superstitious sometimes. And because I've made 3 trades in a row not showing them, I'm like, well, I don't want to show them and then jinx myself and mess up this time. Plus, it's like, I don't want to get crushed on stream and have everybody say, oh, look at that, you suck. But that's fine, too, because that happens. So I'm going to try to put something on screen. I'll have to rearrange things a little bit. It's just there's so much going on. I have terrible prep. I'm not adequately prepared. Definitely not adequately prepared. All right, let me get to my accounts and portfolios over here. So I've got some trade. Basically, I have trades on all my accounts. Now, my long account, I don't normally trade. Oh, man, my long account is super red right now. Look at that. Nobody's happy. That's terrible. That's terrible. That's okay, though. I still have, how much cash do I have left in there? Oh, ouch. What's my, what are my those calls at? Okay, not too bad. Hey, okay, not too bad at all. They took like a 30-40% hit, which sucks, but I only bought 2 of them in this account, so not a big deal at all. And then how's my Robinhood looking? My Robinhood's looking not the worst, actually. So I have those calls. Okay, so that's nice. So, see, that's the good thing about doing this. It's kind of a gamble to buy these option contracts, but at the same time, I bought cheap strangles. And the fact that there's been a decent amount of movement has actually upped my account a little bit. But the downside is, see this green ascending little candle thing right here? This is hurting those contracts, right? So all the ones that I bought that were short, that were looking really good when this red candle came in, they're starting to not look so good because they're extremely short term. And the reason that is because of gamma. Now, there are different, I've talked about the Greeks a little bit. I haven't really done a whole thing on them, but gamma is basically the rate of change of delta. And delta is your profit and loss, your risk, basically. So delta might be something like 30 or 40, but gamma, if it's a long way away from expiration, gamma is going to be like nothing. Be 1 maybe. But when it's right up at expiration, gamma is huge. So you might hear something about gamma risk. That's when people sell options. It's not a good idea to sell short-term options because if things move just a little bit against you, gamma can hurt you because it can make delta move so much quicker. Like when the expiration date is far away, gamma can't influence delta as much. So you're basically just getting delta as the stock moves. So you'd be getting that 30 or 40 bucks every time. But if you got 30 bucks of delta and 25 of gamma, the next time it moves, that 25 of gamma is going to be even more, and so is the delta. The delta is going to be like 25 more, plus gamma is probably going to be 30 the next time. So that's the good thing about options, or the bad thing, depending on how you're looking at it. It can move a lot quicker because of stuff like that. Delta and gamma work together. So today I have a little bit of gamma exposure, which I don't normally like because of that whole fact. I mean, gamma can hurt you. This will hurt gamma right here so bad. Like if you had a long-term contract, this won't matter at all. It'll probably be almost the exact same price. But if you have a short-term contract like I do, this is going to crush them. So where are we down? Okay, so my contract, all right, so here, perfect example. I had these calls in SPXU. They were up 40% just a few minutes ago. And now that this candle has turned red, they're up 10%. So I lost 30% of profit in just like 3 minutes. You can see that's how powerful gamma is. And I mean, these are cheap contracts. So it's really not a big deal. I mean, those ones I paid like $19 or something for. So it's really not that much. And I didn't buy a ton of them. I was actually saving my cash to make a trade during Jerome Powell's speech. So where are we at right now? Oh, we got 1 minute. Powell's about to get going. Okay, I need to get the sound and everything going. Hold on. So let's unmute this guy right here. I can hear that. I don't know if anyone else can. Let me switch this over so that we can hear the beautiful piano music. Hopefully that's not duplicating. I don't know if it is or not. We'll see. But we're going to have Jerome Powell here in a minute, so get ready for that. You know what? I want more upward visual. Let's do that. Yeah, chat is disabled. I would be very surprised if the Fed actually let chat. Well, I mean, this is YouTube. If the Fed's YouTube channel let chat go, it would be insane. They're never going to do that. All right, any minute now, we're going to have Jerome Powell come out. I'm going to get my trades ready. Where do I want to be? I want to be over here. Uh-oh, here he comes. Here he comes. All right, get ready. Jerome Powell's about to show up. I'm going to mute myself the second the door opens. We'll see what happens. So it's usually like a few minutes. Oh, man, I need to get in these contracts over here. All right, I am opening this one. Here we go. What are these, 15s? Yeah, we'll see if it goes to 15. It is flat right now. Are there zero buyers? There are zero buyers. Oh, these are terrible options. Absolutely terrible options. Okay, I think I'm going to go over here. Oh, here he comes. All right, let's do this.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
There we go. That's an important part.
Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Hey, Ronan, what's up?
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6%.
That was key. They've raised their projections.
2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, here we go. This is the last part that we're waiting for. My calls are not up that much. They're break even right now. They were up, but they're down. Now they're down.
Give us a little detail around
Shit,
how
man.
you'll know
This
when
sucks.
to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is The overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular: to achieve a period of growth below trend, and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think.
Market likes that.
Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Ah!
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate.
All right,
to
there we go.
restrictive
Now we're
level
up a
that's
bit. Come
restrictive
on.
enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
There we go. Now we're breaking out the high of day. We're testing it. We're kind of wrestling with it. Took us a little while to get over VWAP, and now we're actually making some progress. I'm thinking about closing, but I'm not sure yet.
Projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down.
All right, I closed my
They
big
need
position.
to,
Gotta pause.
and as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2%, because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago, in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation.
He looks like a beta rooster. Are you talking about Jerome Powell, Salome Fishby?
We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions. As you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly.
Here we go.
I'm
This is what I've
just
been waiting
wondering
for.
Whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I
Exactly.
think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Interesting.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
All right, I'm going to do one more, and then we'll call this meeting.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates.
Somebody fix that mic,
and
jeez.
indeed, Treasury rates moved up, so we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet. from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris, Rugaber.
Okay, I'm going to go ahead and call it there. I have to mute it because I can still hear it in my ear here. All right, so I'm going to leave that going so we can see until I click on the thing and then it goes away. All right, so basically we had a similar movement to the last few Fed meetings. However, we're looking a little bit toppy right here. So I'm going to back this up, which is going to get rid of that. Yeah, that's fine. So we're a little bit above the day's high, but right now we're actually below the day's high, but this little section right here is kind of looking toppy, and we're trending down. The volume is dropping a little bit. You can see we had, if I zoom in a little bit, we had an increase in the volume as we were coming up here. I actually ended up buying some calls on the Qs right here. I went with the direct Qs because when I tried going with the triple leverage one last time, it just didn't work as well. It's for what I like to do, it just didn't work as well. So I went with the Qs, ended up making a nice little chunk, sold it somewhere in here. I think it went to the top, and where was, yeah, so we were kind of like switching over to this candle right here, I think, and maybe it was coming down, maybe it wasn't. I ended up dumping somewhere in here, so I made a nice little chunk on those. I still have some other plays going on right now, so really I'm a little bit ahead, but I'm not ahead that much because I bought too many short-term plays and we didn't get the movement that I was hoping for. Now, I didn't buy a ton of short-term plays. It's not really going to hurt me. I'm still up, which is nice, and I can get out of some of these, but I do want to hold a few because I think we're going to have a trend one way or the other over the next few days, maybe a week or two. So I have some October contracts that are looking for a pump in the market. I also have some shorter term contracts that are looking for a drop. So if we get a panic tomorrow or in the next couple of days, I'm going to profit off of that, which will be nice. If we get a nice gradual uptrend, I'm going to profit off of that too. I'll end up letting those go in a week or two. I don't want to get them too close to expiration, but if I can make a little bit on a trend, great. If it ends up staying where it is, goes completely flat over the next week or so, that's the worst case scenario for me. That means that I'm going to lose in pretty much every department, and I'll take my trades off the table early enough to still have something. I'm not going to ride these ones into the grave. Well, I'm going to ride the weeklies into the grave because I've got 3 days and they were cheap as hell, so I'm just going to keep them. But I'm going to ride this, hopefully, into some kind of profit. But I really don't like how it's just sitting here. I mean, this is not my favorite. I mean, last time we kind of had something similar. We had a pump and then it kind of leveled out for a while, but then it went again for the end of the day. But we've got less than an hour. We're in power hour right now, so we're going to see if we pump a little bit. Let me pull up Powell, see if he's still actually talking, because once he's done, the media is going to start going nuts and talking about all their stuff. Looks like he's still going, so they're not quite done yet. We got this dude, Fox Business, talking. They're going to be they always try to ask him questions that move the markets, that make people either scared, or they basically straw man the Fed's arguments and then say, here, what do you think about the extreme version of your situation? What if we push everybody into unemployment and all that stuff? I mean, they're going to do stuff like that, but the Fed's used to it. These actually, to be honest, this meeting's questions were actually a lot more mild than I was expecting. There wasn't, last few times they came at them pretty hard, but this time it was basically like all the stuff they actually wanted to know. Right, there was a little bit of fear mongering, but not as much as I was expecting. I mean, this is really not the outcome I was hoping for. Every Fed meeting we've had kind of this pump towards the end of the day. I don't know if we're going to get that today. The way this is looking, this volume drop, the way it's trending down, if you're a technical analysis person, it's making this nice little bear flag here. It could resolve to the upside. I'm hoping it does. I'm going to hold on to my trades just in case. I mean, I'm up, but if all those trades end up not working out, then my profit is very little, and this was kind of a wash, which is not the worst, because I was worried about a loss, really, because I think I've done 3 in a row. Now it's 4 in a row, so I've gotten 4 straight trades on the Qs in some fashion in a row, all successful during the Fed meeting. If I had not put on any of those other trades, I'd be up quite a bit right now, and I could be like, all right, I'm done, see you later. But I've got these other trades on, and I have to sit there and kind of see what happens with them. I'm still watching that strike that I was in. I had the 300 calls on the Q. It's below where I sold it. I mean, I bought it in the 500s and I sold it at 700. Right now it's or a little over 700, I should say. But right now it's in the mid 650, 640. So and it hasn't come back up to that 700 level. I mean, I got it when it was close to the peak. I mean, I think it was in the mid 700s or no, it was in the low 700s. It was a little bit above where I ended up selling it, but I got it at a good time because I didn't like the way it was behaving. I mean, this took forever right here. This candle, these are 5-minute, right? Let me double check. Yeah, these are 5-minute candles. This 5 minutes felt like an eternity. I remember sitting there just saying, like, this is the longest 5 minutes I've ever felt in my life, because it felt like it should have been 20 minutes and it was still on the same candle and it just wasn't pumping. I mean, when you've got money on the line, time slows down and you see these stops and your heart is just like, oh God, your chest is all tight. I don't like it, man. I really don't like it. But you know what? It ended up being okay. We got through that. I pumped it. This is a classic 3-bar play where you see a pump, a relax, and a pump. And that's kind of what happens sometimes with these Fed meetings. I mean, we've had way more power to the upside before. I mean, it was like green candle, and I was able to get out there, but this was so much more nerve-wracking. I mean, getting in on here, I mean, this was starting to pump, so I didn't even get the bottom, or I didn't get it down here, which would have been nice. I got it somewhere in here. I mean, I could have had those contracts at probably like $50, $100 cheaper than what I actually paid for them if I had gone in just like 3 minutes earlier or something like that. Maybe even less, maybe a minute or two. But I saw it going, and I was like, all right, I got to get in now. He's talking about it. He's said enough to say that this could pump. So I got in, and then it just sat right above where I was buying. In fact, when this candle was going down, those contracts were slightly underwater. So, I mean, I probably bought it close to where this was. I mean, this was bad. It was like they were up just a little bit and then down and then up and down and up and down, and it just stayed there, man. That's so nerve-wracking. So I'm glad I got this pump, and once I got that, I was like, all right, any chance that it stops, I'm out. I don't care if it keeps going. I'm just so tired of feeling like this that I don't want to deal with it. And look what we're doing. We're dropping back to VWAP. See, that's what happened. If you look at this right here, this all centered around VWAP, because that's what people were looking at. They thought, all right, we had this pump right here. Jerome Powell saying things are mostly in line, but not perfectly. They adjusted their dot plot, which is kind of what I thought they were going to do. And the way he was talking, he was still very hawkish. Very hawk. He was somewhat hawkish, more hawkish than he'd been in the past, and that was what was driving this little red candle right here. People were waiting for him to say a lot. People were waiting for him to be more dovish, but he never did. He ended up saying, we're going to stamp things down. I mean, it's going to be hard. Look at this. We're back below VROP. This is dropping right now. Are we still talking? Is this posts? No, we're still going. Fed's still talking. Oh, man. That's not good. I wonder, of course, I missed what they're saying. Okay, well, it's a good thing I got out. Look at this. This is brutal. So pretty much everything I have is not looking good right now. Let me see is my account back down? It's down a little bit. Okay, cool. So I've lost, it was 70%, 77%. Now we're down to 41%. Okay, so, I'm up 40% instead of being up 70%. Big deal. And the good thing about this, though, is those weeklies that I have, they're pretty much dead right now. So downside movement isn't going to hurt my trades, my short-term trades. It is going to hurt my long portfolio, and it's going to hurt all my long options, which is mostly what I have. I have like 80 or 90% long stuff. So this is not going to be easy for me if we get this nice drop. I mean, I'll benefit from my little trade here, which will take some of those losses out, and it'll give me a chance to continue buying with more cash, because right now I have more cash than I started with on the day, which is wonderful. That's what I was hoping for, popping a little extra cash in there so that I can buy some more on a continued decline. But this is overall kind of a flat meeting. I mean, look at where we're centered around right here. Drop, bam, kind of argue a little bit with it, kind of hit the resistance and then break through. And this is why I don't like buying breakouts, because this is what happens a lot of time. You normally the move is exhausted by the time you get to the point where the breakout happens. So I just don't ever do them. I mean, that was one of the first things I learned. And I think that's one of the first things traders learn when you are trying to trade. But the problem with that is you have to have a lot of power behind those breakouts. Something like GameStop was a good breakout, right? Like when it had that crazy squeeze back in 2021 and it hit its old highs and everything. Same thing with Snapchat. Snapchat had an IPO price it never got to, and when it finally came back to there, it had enough power to break through it. This was basically saying, okay, we are in line with what the market, we're somewhat in line with what the market thinks, but the market thinks things aren't going to be that great. So it's like, yes, the Fed came out and said basically what the market wanted to hear, but now the reality of those things has to come in. I mean, they're going to continue raising rates. They're talking about another 100 to 125 basis points by the end of the year. I mean, it could be less than that if things start to come down, but like I said, this is a gradual process. It doesn't happen right away. So the next CPI number, the next PCE number is probably going to be high. Both of them. I mean, everything is probably going to stay high for a while, and it's going to cause the Fed to keep doing what they're doing, most likely. And if that's the case, that's going to hurt stocks, right? It's going to make bonds more attractive. It's going to make the dollar more attractive. It's going to make stocks less attractive. So people are going to be moving into other assets that are more profitable. In fact, right now, the yield on the 10-year, I think, is basically pushing up against what you'd get with dividends on stocks, which is why people are moving over to that. Because like, all right, do I want to take these movements on stock to get this dividend? Or do I want to move into something like a fixed income asset that's a lot more stable and will give me, a guaranteed payout, right? It's regular guaranteed payments. It's so much. If you have enough money, bonds are so much easier than dealing with stocks because stocks are high emotion. There's a lot of movement. Anything could crash the stock. You don't know what's coming in the pipe. I mean, it's just there's so much to it. So people are thinking, why do I want to be in stocks with all the volatility and the craziness when I could be in bonds and continue to make money? Considering bonds are probably going to continue to go up. I mean, as we have this drop, bonds are going to look better and better. As inflation gets tamped down and the Federal Reserve hits things harder, bonds are going to look nice. So if you have trades on bonds, in fact, there are bond ETFs you can play that do that kind of thing. I actually don't do that. I really need to, but I mean, I'm spread so thin already with everything I'm doing, and I've got these plays on that I have to wait for, which I really don't like because it's tying up so much of my cash that I could be using for other stuff. Like those plays that I've been waiting for all year, if I had been able to use that cash on these Fed meeting plays, I'd have so much more money right now. But I have the mindset that like as soon as I get out of this, it's going to move. Because that's what always happens, right? Like you think you're going to get into something or you think something's going to go up. So you get into it, you wait, it never goes up. Maybe it goes down a little bit and then you sell and it finally goes up. We've all had that experience. It happens. It's part of being in the stock market. So I have that fear with this kind of stuff. When I don't want to get out of some of those plays, like my cannabis play, that's not going to happen. I know it's not going to happen, but I'm so deep in this play right now. It's the sunk cost fallacy, right? I have to make my money back. No, it's more like, I can't get a very good price for the leaps that I hold right now, so I might as well hold them because I have time. And if something does happen last minute, if there is some kind of breakthrough in the cannabis sector, then I'm out. I mean, I'm taking profits. Even if I miss a big run up like I'm trying to grab, it's just this is so brutal. I need to get out of it. Because everything else, my year has actually been really, really good. Everything but that stupid cannabis play has been really good. I mean, I've had a few losses. Of course, there's been some stuff. It's not perfect. But if it wasn't for that, I mean, I would be having my best year ever. I'm actually trade-wise having my best year ever. I mean, that break that I took last year actually ended up helping me because I was able to clear my mind. I'm making a little bit more progress on things. But I still have that fear that as soon as I get out, things are going to move. So, number one, I can't get a good price for it, so I'm staying in. Number two, I have that fear. Number three, I have time. So it's still at a point where like I could get out and, I probably lost a good 70% of what I put in there. If I can get some of that back, that'd be great. But, I just don't want to do it at this point. I'm doing so well at other stuff. I've made up for those losses. So it's kind of at a point where I'm just going to be okay with it. But right now, this was an interesting day. It didn't go as well as I'd hoped. I still made money. That was still great. But all my other trades are not doing well because the exact thing that I didn't want to happen is happening. It's staying flat. Down, up, down, in the middle. Right? It's still up a little bit. We're kind of on a trend that could be rising. It's above VWAP. You notice when this candle came down and pierced below it, it didn't stay down there for very long and got rejected. So we do have some upward pressure, and I can see things moving by the end of the day or the next day if that's what ends up happening. But right now, I don't know. It's looking very flat. I don't want to be in it. As soon as I can get out of any of my other trades that aren't doing well right now, I'm going to do it. But I'm going to hold some other ones because I do think that there's going to be a trend one way or the other. And if there's a long-term trend up or down, then I've got plays for that, and that's okay. If it just stays where it is, that's not so good. So I'm going to go ahead and wrap this up. This was probably one of the weakest Fed meetings that I've seen so far as far as streams go. It's still good to make money, but I'm complaining because it really wasn't that much. Everything else went to crap. My normal trade, the one that I make every time, did really well, but I tried to do all this other stuff thinking like, oh, if I can catch this and catch that, it'd be great. If it moved the way the last couple of Fed meetings did, these trades would have been extremely profitable. I would have made so much money, but it didn't. And I think that's why those contracts were so cheap, because people kind of estimated this. They thought, all right, the Fed is going to come out and say probably what we think they should say, which is not the greatest. It's not the best thing to be saying. We're like, all right, the economy is going to suck for a while. That's what they said. They came out and said, all right, we're going to keep making it worse. The economy is going to suck. Have fun with that. And that's because they said that. The market is going, all right, cool, but now we have to deal with the reality. So good stream. Thanks for the info. Thanks for being here, Barbarian Blast Machine. I appreciate it. I'm going to get out of here. This was an interesting day. I'll talk about this more on Sunday. I got to figure out what I'm doing. Hopefully the trades will end up better by Friday because I have some weeklies that are going to be worthless, most likely, but we'll see if anything comes with that. So thanks for being here, hanging out with me. I appreciate it. I'm a Stockalypse. I stream every other Sunday at 3 p.m. Pacific. I'm talking about the week's events. I'm talking about my plans for the future. Talking about anything people want to talk about in the chat. If I have knowledge of it, I'll talk about it. If I don't, I won't. I'm an intermediate trader, so I don't know everything. There are things that are above my head, and I could go learn those. But anything else, I just kind of want to share what my experience is. So come hang out with me. Like I said, every other Sunday, 3 p.m. Pacific. I'll be talking about stocks, options, and crypto. And anything anybody else wants to talk about. So have a good day. Hopefully you make some money. Hopefully you stayed safe. I'll talk to you later.